On a June morning in 2026, the smartest money on Earth got nervous. The world's most valuable company was a chip maker named Nvidia. Not an oil giant, not a bank, a maker of computer chips. It was worth roughly $5 trillion. That is a number almost too big to picture. Then, over 2 days, the floor seemed to shift. Tech stocks sold off across the entire planet. From Seoul to New York, screens turned the same shade of red. And one question went viral on every trading desk. Is the AI boom a bubble about to burst? Is the trillion-dollar question of our decade? So let's follow the story behind the money. It started before most of America woke up. In South Korea, the Kospi index plunged about 10%. Korea is home to giants like Samsung and SK Hynix. These firms make the memory chips that feed AI servers. So when AI fear spreads, Korea often feels it first. The drop was violent enough to trip a circuit breaker. A circuit breaker is an automatic emergency halt. When prices fall too fast, the market literally stops trading. The idea is to let panic cool before it feeds itself. Think of it as a referee stopping a fight. By the US Open, the fear had crossed the ocean. The Nasdaq fell about 2.2%. It was the second straight down day, and nobody wanted in. The hardest hits landed on the companies that build AI itself. Nvidia, the king of the boom, fell about 4%. Its rival AMD dropped roughly 6%. Intel slid about 7%, Micron over 8%. Broadcom, a quiet giant of AI networking, crashed too. Broadcom makes the chips that link servers together. The pain wasn't only in the chip makers. The S&P 500 closed down about 1.4%. That index tracks 500 of America's biggest firms. When it moves, almost every retirement account moves with it. So this was a story for ordinary savers, not just traders. To understand the panic, you have to understand the build-out. And here's a twist the headlines often missed. This sell-off wasn't only about artificial intelligence. A second engine was running underneath it. The U.S. Federal Reserve had a problem. Inflation stayed hot. Its June projections put inflation around 3.6%. That's well above the central bank's 2% target. With prices stubborn, the Fed kept rates elevated. The Fed funds rate sat near 3.8%. Investors feared interest rates might stay higher for longer. Here's why that matters for tech stocks. High rates make far-off future profits worth less today. And high rates make expensive growth stocks look fragile. So is this the bubble bursting? Many strategists said no. They called it a valuation adjustment, not a collapse. And expectations reset after months of euphoric pricing. Company earnings weren't breaking down, the hype was cooling. Picture a rubber band stretched too far, snapping back. It hurts, but it isn't the band breaking. But a reset and a bubble can look identical at first. Both begin with sharp, frightening price drops. The difference shows up only over the months that follow. A reset settles at a calmer level and recovers. A bubble keeps falling far past where it felt cheap. To tell them apart, follow the money into the build-out. Since 2023, the biggest tech firms made a staggering wager. They decided artificial intelligence was the future of everything. And the future, they believed, had to be built physically. That meant data centers the size of small towns. Windowless warehouses humming with row after row of servers, packed with vast numbers of Nvidia's specialized chips. The combined spending climbed into the hundreds of billions a year. That rivals the budgets of entire countries. It is arguably the fastest corporate build-out in history. Imagine pouring the cost of a moon program into computers, and then doing it again year after year. That is the scale we're talking about. The spenders are called hyperscalers, the cloud giants. Microsoft, Google, Amazon, and Meta lead the charge. They rent out computing power the way utilities sell electricity. Each is pouring tens of billions into AI capacity. This kind of spending is called capital expenditure, or CapEx. It's money spent now, hoping for profit much later. CapEx is like a farmer buying land and seed before any harvest. You spend first, and you pray the crop comes in. And the scale of this CapEx is genuinely unprecedented. These four firms are racing each other, not just the market. None wants to be the one that fell behind in AI. Wall Street loved it, until it started asking one word. When does all this spending actually pay for itself? The chips were out. The power bills are enormous. The buildings, the cooling, the staff, none of it is free. To justify the cost, AI must earn back huge sums over time. For now, the spending races far ahead of the revenue. And that growing gap is exactly what makes investors twitchy. Believers call that gap an investment in tomorrow. Skeptics call it a hole that has to be filled, or else. Same numbers, two very different stories. The truth will depend on what AI actually earns. And that answer is still being written. But there's one detail that makes skeptics especially uneasy. Here's where the story gets strange and a little uncomfortable. Critics point to what they call circular financing. Picture a chip maker that invests in an AI startup. That startup then uses the cash to buy the chip maker's chips. The money goes out one door and comes back in another. Reportedly, some of these deals have been worth tens of billions. On paper, this looks like booming demand for chips. But some of that demand is funded by the seller itself. It can make a market look healthier than it really is. Imagine a shop that lends you the cash to buy its goods. Sales look great until you ask who's really paying. If outside demand is weaker than it appears, the loop is fragile. To be fair, big tech partnerships are normal and often useful. Strategic investments help young firms grow faster. And much of the AI demand is clearly genuine. The worry is scale and how much rides on it. A little of this is fine, a lot of it can mislead. Because we have seen a story shaped like this before. History doesn't repeat, but it often rhymes. In 1999, a new technology promised to change the world. It was called the Internet, and the hype was electric. Money flooded into anything with a .com in its name. One company sat near the center of the boom, Cisco. Cisco built the plumbing of the early web. Sound familiar? Nvidia builds the plumbing of AI. In a gold rush, the surest profit is selling shovels. Cisco sold the shovels of the Internet age. Nvidia sells the shovels of the AI age. Both became, for a moment, almost untouchable. And both were priced as if the boom would never end. Briefly, Cisco was among the most valuable companies on Earth. Then the dot-com bubble burst around the year 2000. Cisco stock fell roughly 80 to 90%. Intel and other chip makers were crushed in the same wave. Fortunes built over years vanished in months. Many of those stocks took a decade to recover. Here's the painful part. The Internet really was that big. It reshaped shopping, work, and daily life completely. The technology was real. The prices were just too high. Investors were right about the future, wrong about the timing. They paid 2010 prices for 1999 reality. That gap between vision and value is where bubbles live. There's a famous gauge for whether stocks are expensive. It's called the Shiller-Cape ratio. It compares prices to 10 years of company earnings. The higher it climbs, the pricier the market is. In early 2026, it sat near 40. That's close to the level seen at the dot-com peak. A high cape doesn't guarantee a crash is coming. It can stay elevated for years before anything breaks. But it does mean the market has little room for error. Pay top dollar, and you need everything to go right. So is 2026 just $19.99 in new clothes? Not so fast. Because this time, some things really are different. Now let's give the optimists their fair hearing, because the bull case is genuinely strong. Start with the biggest difference from the year 2000. Back then, many dot-coms had no profits at all. Some had barely any revenue, just a website and a dream. Today's AI leaders are wildly profitable, established companies. Nvidia isn't selling a promise, it's selling chips for cash. Its revenue and profits have exploded, not just its stock. Customers are lining up and paying real money today. Microsoft, Google, and Amazon are among the richest firms ever. They're funding AI from real, gushing cash flow. This isn't debt-fueled speculation by tiny startups. It's the strongest balance sheets on the planet placing a bet. These firms could absorb a setback and keep going. They earn enormous profits from search, ads, and cloud. AI is a new bet layered on top of those money machines. That is a very different risk than a startup with no income. And then there's the prize everyone is chasing. The prize is productivity, doing more with the same effort. AI can write, code, and analyze at remarkable speed. It can draft, summarize, and assist millions at once. If it makes workers meaningfully more efficient, the math changes. Even modest gains across a whole economy could be worth trillions. Optimists say we're early in a real industrial revolution. Spending big now, optimists argue, is exactly right. Whoever builds the most capacity could own the future. Underbuilding, they say, is the real danger. The internet rewarded those who built early and boldly. AI, they believe, will reward the same nerve. But every bull case has a shadow. Here comes the bear. The skeptics don't deny that AI is real. They question whether the price tag makes sense. Their first concern is that capex versus returns gap. Hundreds of billions are going out the door right now. But the AI revenue to match it is still arriving slowly. At some point, investors stop accepting "trust me" later. The second worry is hidden inside the accounting. AI chips are powerful, but they age fast. Newer, better models arrive almost every year. That means today's chips lose value quickly. They depreciate. It's like buying a car that's outdated within a year. If they were out before earning back their cost, profits suffer. Accounting choices decide how fast that cost shows up. Spread it over many years, and profits look better today. But the chips may not last that long in practice. Some analysts fear the true depreciation bill is understated. If so, reported profits may be flattering the picture. And that's only the second of four worries. The third constraint isn't financial, it's physical. AI data centers devour staggering amounts of electricity. A single big campus can draw as much power as a city. Power grids in some regions are straining to keep up. You can't run trillion-dollar AI on a grid that can't deliver. Building new power takes years, not quarters. You can build a server hall in months. You cannot build a power plant that fast. Transmission lines can take years to approve and lay. That mismatch could leave expensive chips sitting idle. Idle chips earn nothing while still losing value. That bottleneck could slow the whole boom down. The fourth worry is concentration. A handful of AI-linked giants now drive much of the market. A few names carry an outsized share of the major indexes. When they sneeze, whole index funds catch a cold. That's exactly what June's sell-off showed in miniature. Few winners means everyone is exposed to the same bet. So what does this leave us? Boom, burst, or reset? Honestly, all three outcomes are still on the table. In the boom case, AI delivers and the spending pays off. Productivity rises, revenue catches up, and prices hold. In the burst case, the gap never closes and prices snap. That would echo the long, painful fall after 2000. In the reset case, valuations cool while the technology grows up. prices step down, but the build-out keeps going. The hype deflates without the whole story collapsing. June 2026 looked most like that middle path. Remember, earnings didn't collapse in June. Expectations did, and that's a healthier kind of pain. A reset can wash out froth without ending the story. But high inflation and high valuations leave little margin. With rates elevated, mistakes get punished faster. The next surprise could push fear back into the system. One bad earnings season could reignite the whole debate. The truth is, nobody can call the top with certainty. Both things can be true at once. AI can be a genuine revolution and still be overpriced today. That was the lesson of 1999, and it may be ours. Great technology and a bubble are not mutually exclusive. The build-out is real. The payoff is still unproven, which is why the smart money is watching, not cheering. One last thing, and it matters. This is analysis and history, not investment advice. Nothing here is a recommendation to buy or sell anything. Markets are uncertain. Please do your own research. We follow the story behind the money wherever it leads. If this helped you think clearly, subscribe to Chronicle.